In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, welcome back, Market Rebels. And there's the familiar sound, Stu. It's 4 p.m. It's time for Coach's Corner. Looks like we were down, what is that, down about 1% maybe?
Yeah, a little bit under, little bit under.
Kind of lower lows and lower highs all through the day.
All through the day. All you had to do was draw your trend lines at 11 o'clock and just stay in the program.
Just stay right in there. Well, anyway, welcome back. We do this every 4 p.m., every Thursday, 4 p.m., right on the closing bell for anybody who might be new. And the idea of Coach's Corner is we like to showcase some of our professional coaches here at Market Rebellion to give you different insights into the way that professional traders see markets. And today,
who would that be, Bill? Is that me?
That you would certainly be one of them. 29 years on the PhilX will certainly, as a market maker and specialist, will qualify you.
Okay.
We're going to talk about one of the most important topics, I think, in all of options trading. And I think we're going to catch a lot of people by surprise with this one, Stu. So let's start off with our, what's that?
Is that our topic? When to get out?
No, that would be another good one, though. But we're going to start off with Chalk Talk, which is our little trading huddle right here. Little kind of a trivia question for people to think about, which we'll answer at the end. And so here's the question. We have historic volatility is at 20%, and at-the-money call is trading at 30% volatility. Now, pick your numbers. We just did this for an example. The point is that the call is trading at a higher volatility than historically. And so the question is, do you have an edge by selling the call? So once again, jot down your answer. We want you to commit to it. And then we're going to talk about that. We'll come back and revisit the answer. And I think this, again, is going to really take people by surprise, because today, Stu, we're going to talk about the unfairness of fair value.
No,
How can fair value be unfair?
Let me ask you a real cool question on that Chalk Talk question. Can we go back to that for 1 second?
Absolutely.
So if I made that number, the ATM call is trading at 25% or 35% or 22% or 37%, should that change my outlook on my answer? And I want people to think about that.
I was going to say, yeah, think about that.
That's kind of where we're going with
But
this.
bring that up as well. Yep, good point.
I think that's where we're going with this. Was that your idea?
You got the idea. Yep.
Okay.
So we're going to
All
talk
right.
about the unfairness of fair value. And I like this for a topic because when we talk about fair value, just the definition makes people think, oh, it's fair. And therefore, if I sell this option for 3, that's what it's worth. Or if I buy this option for 3 because the model says it's fair. And again, we're going to kind of turn that on its head. We're going to show you a little bit of a surprise from what most traders would think. So the first thing to realize is that,
Bill, does that mean if it's not that number, it's unfair? And therefore, maybe we shouldn't be getting into that?
You're looking at the other side of the trade.
All the viewers have to, you got to step outside of your box. You got to push the limits of where you think the edges of your circle are, and just think outside the box and think about the other side of the trade. And it's not so black and white. It's not really it's not a thing that you can just say, oh, yes or no. There's a lot of an art form in there, and you just have to keep an open mind as we go through this kind of stuff. So Go ahead. Sorry.
So that's a lot of what we're going to drive home today is that people think just because it's trading at a higher level than historically, you need to dig deeper than this. So let's start off with a Black-Scholes pricing model. You might see this in a different form in your broker's platform, but let's say that it tells us that this option is trading for about 285. Now that's based on the parameters over here, stock at 100, strike at 100, 30 days to expiration, and I've chosen 25 volatility. But what the calculator
could have chosen anything, didn't matter, but we chose 25.
Correct. Doesn't matter. The point is that whatever number the model spits out, this is the option's fair value. Notice that the calculator even knows that. It doesn't say this is the price you're going to see in the market. It says this is the value that you should see based on these parameters.
Based on those parameters, which are dynamic. Those parameters,
they are dynamic, and they're unknown.
Right? Has anybody seen a market in a stock where the price changes? It's kind of a joke, right? Of course it changes. Do strike prices change? Well, the one that you own or sold won't really change. However, the stock will move around a strike price and have a greater or less distance. The days to expiration, of course, that changes every day, is one less day in an option's life. And of course, pricing levels or implied volatility, that changes as well. So these are just inputs that go into a model, and that's it. And bang, out comes a price.
So we've got this fair value, and here's where people start to get tripped up. They say, oh, it should be trading for 285, but the market's priced it at 4 or some number above that. And so therefore, if I sell this option, all should be rosy. I'm going to just sell this option. It's going to be in my favor. Stock price will sit still, and I'm going to collect this $4. Why? Because I sold an option that's overvalued. And what we're going to show you is that that's a really, really risky assumption. So here's why. We're going to look at a number of...
Let me jump in here for 1 second, kind of give you a little example of something that I can remember specifically. This trader, this broker comes in and he starts bidding for these puts. He bids a half a dollar. They were valued just like this. They were valued at about a quarter. So the guy comes in and he bids half a dollar, and they looked like a screaming sale on a volatility basis. Sold. He says, now what? Anyway, make a long story short, now they traded at 3/4. Now they traded at $1. Now they traded at 1 1/4. All sell sides. Well, I'm a buyer at 1.5 now. All because the picture changed. Sold. They're all over fair value. Well, guess what? Now I got to change my implied volatility to 65 instead of 25.
And now it looks like a good
value, because now they're trading at 1.5 and they're 1 3/4 value. It's a dynamic movement.
Yep. It's not just that snapshot. So here's a good example. We're going to do a few examples, and then we're going to drive it home with an actual stock market. But let's start with a coin flip bet. Let's say that you and I, Stu, are going to flip a coin, and we're going to bet $1 to make $1. So if I win, I get $1 from you. If you win, you get $1 from me. Well, over time, what we're charting is the P&L. So you can see at this point, one of us was up about $20 down here. Somebody was down about 20, but it's not a straight line, even though that's the fair value of the bet.
So what is straight line going to be? Every other time it's going to come out heads or tails or heads.
Exactly.
Tails and heads.
No, you can go on long streaks. You heard Elliot talk about this a few weeks ago, where the fair value is a long-term concept, whereas depending on when you got into the game, you could be on a screaming run. You could be heading into big losses. You're taking a slice of that picture.
Slice of time.
Fair value is a long-term concept. So here's what you want to think of. Yes, the profit at the average level here is zero, is zero. However, the average level of profit is not zero. And this sounds like a little bit of a play on words, but look at how many times we actually touched zero. You can count them.
Not too
right
many.
there. But look at how many times we were not zero.
A lot.
We spent far more time away from fair value than at fair value. And this is part of the concept that we're trying to drive home. So you could also pick two arbitrary points. Here I've got plus 15 and minus 15. You're going to pass through there an infinite number of times if you're willing to sit there long enough. Make them plus and minus 20, plus and minus 100. You will pass through them an infinite number of times, even though fair value is zero. This is part of...
Think about the market, folks. Think about the market. So the market, on average, we'll say 50 years, might return approximately 8% over 50 years.
Right.
On any given year or on all the years?
Probably never that.
Really, is it going to be 8%? No way. It's never going to be 8%. I mean, maybe once or twice it might be 8%, but it's going to be 20%. It's going to be down 5%. It's going to be up 15%. To expect 8% every year is ridiculous. And if that's your fair value calculation, to then go ahead and extrapolate for that and say, well, I expect 8% a year this year, you're just way off base. It's
not going to happen.
It's in the big giant picture of things. Not that slice of time, but over that 50-year period or 30 years.
In fact, some things, think like a die. Take a 6-sided die. The average is 3.5, and yet you can roll it your entire life, and you're never going to roll a 3.5. So the average is just what it is. It's giving you the single best number to describe the process, but it doesn't mean that's the thing you're going to see most often. So the average is your best guess. So on our coin flipping game, yes, zero profits and losses is your best guess. But you're more likely to not observe the average. You're more likely to be away from that.
And your best guess in the implied volatility column, that's a best guess.
That's a best guess. That's your center.
It's the market's best guess about the future movement.
And that's all it is.
That's
all it is. There's a lot of variation around that. So let's take
this here. You're more likely not to observe that average.
Exactly. If you had to guess, you're going to say, I would probably pick that it's something other than what the market has picked, statistically speaking, even though that's the balancing point.
Yeah.
So let's take a look at this. Let's take another step. Let's flip a coin 20 times. Now, Stu, how do you suppose, let's say that this is similar to a football bet. We got heads playing against tails. We're going to flip this coin 20 times. What do you suppose would be the crowd's best guess?
10 and 10,
as to the score after 20 times.
10 and 10.
Very good. Always try to trip them up. That would be your best guess.
That would be my best guess, 10 and 10.
And if this were a betting line in Vegas, what would be the point spread? Zero. There's no reason in the world that anybody would take this bet if it were 11 and 9 or 12 and 8. Nobody. The best guess is 10. So now, Stu, here's where we're going to start getting into the stuff where things start getting weird. If that's the market's best guess, that should occur a lot of times. This is like our implied volatility. Oh my gosh, that's the market's best guess. That's what I should expect. True or false?
Well, true. And I kind of thinking like, if I were just looking at it inside a bubble, I would say it should really happen all the time. But of course I know better, but yeah, a lot of times.
A lot of times it will, but let's take a look at the histogram. There's your center bar at 10.
That's
and where does
10.
It line up?
That's the half and half. Yep.
18%, which means you're going to be wrong 82% of the time.
Yeah, think about that. Let's stop
even
for
though
a
it's
minute.
Your best guess.
Let's digest that. 18% of the time that happens, and that means 82% of the time
It doesn't
it
happen.
doesn't. It
Right.
doesn't.
So even though that's the
Perfect.
crowd's best guess that we're going to see 10 and 10,
Yeah.
82% of the time that's not going to be true. And that doesn't mean that, oh my gosh, the crowd got it wrong. It's just the
No, doesn't mean
balancing.
that at all.
All it
Yeah.
was to balance the market.
Does
It
this
doesn't
have
say
something to do with an auction market?
with a what?
An auction market?
Oh, good point. We're going to talk about that in a little bit. All right, now let's take another step. Let's push our viewers out there a little bit.
Yeah.
Will you have more confidence with 50 flips? A lot of
So,
times
I
traders would
suppose
say, oh, with 50 flips, you're almost guaranteed to get 25 and 25. It's
Sure.
another misinterpretation of kind of law of averages or law of large numbers. People think you're going to get closer and closer to a 50-50 split. Let's go check and see what happens. I don't know why it skipped. We went from 18 down to 11. You're going to be wrong 89% of the time, even though that's your best guess. You should
Which is
expect
just-
it to be something other than 25.
It's
Kind of
just
ironic.
another way to, this is just another way to graph that prior graph of above and below that average or mean, if you want to call it that.
When we say it's the best guess, it is the tallest bar. So if you had to play this game, there's no reason in the world to guess anything other than 25, but that doesn't mean you should expect to win the majority of the times because it's the best guess. It's kind of ironic. You're saying, yes, it's the best guess, but it's also the least likely to occur if we look at that versus everything else. We have far more other things that can happen. Now watch what happens if we go to 100 tosses. Now we're down to 8%, 92% of the time, Stu, you're going to be wrong. And we can push this to as low of a number as we want. I could make that center 1%. Could make
Just
it a
by
half a
having more
percent.
tosses.
Now,
Yeah.
what's also happening, it looks like this bell curve is getting taller and skinnier, but it's because we're changing the scale. So let's put them all on the same scale, and there we go. There's 20 flips is tall and skinny. 50 starts to get shorter, which is why that center bar decreased. 100 gets shorter yet. See, we're getting more possibilities out here. You can't see them, but there's little red dots way out here, which is why we're up to 100. It is
So folks,
possible.
think of these as pricing distributions on a stock.
That's where we're going. Correct.
Up, down, more time. Think of it as more time. A $100 stock. What's the probability of it going to up or down 20 in a week versus up or down 20 in a year or 2 years or 3 years? That's what a pricing distribution model looks like. Go ahead.
Yep. So that's why we're seeing these numbers coming way out here. Those little tiny dots. It is possible to get 100 flips in a row. Not very likely, but it's there. And because we have to account for these possibilities, the center gets lower. So the more volatility you have, if you're betting on a 30% volatility option or a 50 or 60, 80, fat chance that you're going to hit that dead center, which is what the crowd thinks is going to be fair value. You are far more likely to hit something that's not it. And you need to account for that when you're setting up your strategy. So now that we've hit...
when you're thinking about selling a cash secured put that's in a 1 1/4 or 2 standard deviation without quantifying your loss, I urge you to think twice about it.
Or 3 times or 4 times.
Not necessarily whether you're going to do it or not, but but how you're going to quantify the effect of, well, this one didn't work out.
Exactly.
That's what risk management is about.
Right. So
And it
now
could
let's
be the
take the
same
same
real time.
concept and let's
Yeah.
start applying it towards an options market. We're going to take another intermediate step first with a Super Bowl bet. But first of all, remember to get educated. If you like this kind of stuff and want to take your options trading to the next level, please visit marketrebellion.com/get started. Lots of free courses and things to help you learn more about options and the markets. So let's go
I have
back
to
to
sign up.
the 2021 Super Bowl, where we had the Kansas City and we had Tampa Bay. And
Unlike this year's Super Bowl where the Eagles are in.
yeah, I know that's your team, but mine's Tampa Bay, so I have to choose this one. So now let's say that Stu is going to be our bookie. And Stu announces to the crowd that he's starting to take bets. And so he says, well, I don't know where the line is. Let me start it at even. We're
Yeah,
gonna
that's
give
a
no
good
point
place.
spreads. So we'll start there, and all of a sudden he starts getting lots of people lining up, and he sees that far more people are for Kansas City.
And we can even say that even is like kind of maybe, if we think the teams are, which one, I don't know, even, we can make the fair value that number. Instead of saying even, let's just say it's fair value. So go ahead.
Yep. So now what Stu would do, or the bookie would say, all right, we have to start penalizing this team, subtract some points off of their final score. So maybe we say, okay, what if we did a 1-point spread
Yeah.
and nobody moves? He said, all right, well, let me up it some more. Let me go to a 2-point spread. And now we get some people that jump ship.
So you get
And this is going to keep going. Now, if he goes too big, let's say if he goes to a 7-point spread, we might get this.
And this is your market, guys.
This is the market. As we're going to find out in a little bit, this is exactly the way that an options market lines up to try to figure out where that implied volatility is.
3/4. Oh, now I got sellers, this is an auction market.
Yep. So now we're going to back down. Let's say we come to 3, which is actually what the point spread was. And what happens now? We end up with an equal market. Now, here's the big point to understand, people. Does that mean that all of the people on the left here for Kansas think it's going to be a 3-point game? See, that's the way that most traders would interpret this. Does it mean that everybody for Tampa over here thinks it's going to be a 3-point game? No, there's people over here for Kansas that think they're going to win by 7 or by 10 or 15 or 20. There's people over for Tampa Bay that are going to say, oh no, they're going to win by 10 or 15 or 20. It's all part of the market.
Can we go so far as to say that there is probably almost 100%, a vast majority of people who think it will not be a 3-point game?
Absolutely correct. It's just the balancing point. It's the balancing point. It doesn't necessarily mean this is what the crowd expects. It's just the point that balances the buyers and sellers. That's exactly what it does. So let's go and take a look at these.
Which is dynamic. Again, it's dynamic. It can move. Information,
constantly
momentum,
changes.
News, Jerry Powell, whatever. More information comes into the market. Even just plain old momentum can push implied volatility.
Sure does. Technicals, all kinds of things. So I went back and looked at the last 56 Super Bowls, and these categories, these bins down here at 47%, 26, 15, 8, and 2 stayed about consistent. But take a look at the numbers. The blue I'm calling predicted. This is what the point spread was before the game. And the orange is what actually occurred after the game. So even though these bins stayed about the same, the actual was almost twice as volatile as what was predicted. That doesn't mean the crowd was wrong. It just meant that that was the balancing point. Half the people were on one side of it, half were on the other, but it doesn't mean that that's necessarily what people thought was going to happen. So even though we've got a big discrepancy, how did they balance the market? Well, again, for the last 50, now there were 2 pushes I've taken out of here, but about 55% of the time the favored team won, and 44% of the time it was the underdog. But statistically, that is 0.8 standard deviations apart, well within the laws of chance. So think about that. We have no idea who's going to win a football game, also counting the fact that we could have injuries and all kinds of things that can happen. But how did the crowd do at splitting these, at making it a fair game by looking at the point spread?
You got to kind of think that
pretty much perfect.
It's going to be close to even. Yeah.
Pretty much perfect. And that's the thing that you have to respect. So just because the markets line up and say, oh, we're pricing this at 30%, that is the balancing point. It doesn't mean that you can't get 35 or 40 or 50 or 60. In fact, you're most likely to not get 30. It's just what divides the two crowds.
Half, 1 and 1 1/4, and then paying 1 1/2.
Yep. So now that we've covered all that, let's take this all the way to the end here, Stu, with an options market. All right. So let's say, here's our quote board. So for people who might not know what this is, we have bids on the left, offers on the right, and these are trades that are coming in. So the guy down here on the bottom left, he says, I'm willing to bid 3 1/4 for 5 contracts. Somebody else comes in, I'm willing to bid 330 because he's willing to pay more. He gets stacked up on top. And this just gets, you're typing onto your broker's platform. That's where it goes, right into the queue. Over on the offer side, these are sellers. So this guy's willing to sell at 360 for 3 contracts. This guy's willing to sell at 345 for 5, and so on. So how does the market balance here? How do we figure out the implied volatility? Well, Stu's going to come in, actually a computer program, but he's going to come in here and say, what price will balance the market? And if we didn't have electronics, we could do just like we did with the football bet. Let's try $2. Let's try 3. Let's try 4. Let's try 4.75. And he could keep going back and forth until he splits the market. So let's say that that number comes up to be 355. Now, what happens here? Well, we have some people that were willing to pay 365. They should be plenty happy to pay 355. We have people that were willing to pay 370. They should be more than happy to pay 355. Over on the bottom right, we have people who are willing to sell for 345. They should be more than happy to sell for 355. So all the people in the upper left and the lower right get crossed. They disappear. And what we're left with are the bids and the offers for the people who aren't filled. So Stu's going to say, who's my highest bid? Who's my lowest offer? That becomes the bid and the offer. And we say, well, what volatility is that? That might be your 30% volatility. Does that mean that's where the crowd thinks that volatility is going to be? Fat chance.
No, it's just so perfect. And that 355, by the way, folks, is what everybody refers to as midpoint. That's your midpoint. And what you see on your platform is 350, 360. What you don't see, which is behind that, is the 365 up to 385 on the ask side and the 345 down to 325 on the bid side, which you actually would see if you went on to something called a level 2.
This is what you would see at level 2 right here. Yep.
Is the 350, 360 with a midpoint, which is now being described as an implied volatility level.
Exactly right. Yeah, so this would be level 2. Many of you have that with your brokers' platforms. So now let's go see if this is true. Does this actually happen in the real world like it did with the football game? Well, I'm going to pick some stocks. Here's Microsoft. The blue line is the historic. We had a low of 22, a high of 55. Look at how the crowd predicted. 25 to 37. Not quite as volatile as the stock. Mm-hmm. Exactly like the Super Bowl bet. Let's try another one. Here's NVIDIA. Crowd predicted between 47 and 67. The truth was 45 to 85. Not at all what the crowd predicted. Here's the SPY. 17 to 28. Actual was about 17 to 34. Again, inside the actual. So we could show you lots and lots of examples of this, but the main point to understand is that whenever you see that implied volatility on your broker's platform, it is the balancing point where you got half buyers and half sellers. And yet none of those people think it's probably going to be exactly that. So
and the thing to remember is it's a perception. It's just the fair value is just a concept. It doesn't really
all it is.
A lot. It's a variation. There's lots of variation around that number. It's
Tons.
not this is what the number is. Let me sell it, or this is what the number is. It's not that at all.
Bad idea.
It's just there's a ton of variation around that number. It's just a tool to look at. And truth be told, fair value in the options world has really nothing to do with this. It has everything to do with put call parity. Is the call priced higher on a relative basis than the put? Oh, the call's a sale. Or is the put price lower than the call? Oh, the put's a buy. That's what real fair value is. It's got nothing to do with, oh, well, it should be 30 volatility. It's traded 40 sold. It doesn't really work that way.
That's how almost every single person does it. We hear it all the time in Q&A. I know you hear it all the time with coaching. So let's drive it home with the last point here. Let's say we have a covered call. This is our risk graph. And it doesn't matter. We could pick an at the money. Wherever the current stock price is, there's a bell curve over its head. So the question we want to ask people, again, with the initial question, we're selling this at 30% volatility.
And remember, that stock price moves.
Well, yeah, that's a whole different story.
It's constantly moving, that stock price. So that means that bell curve is constantly moving.
But at the moment you sell it, it's not. At the moment you sell it, it's sitting right there, and you're saying, okay, it's trading at 40% volatility. And therefore, if I sell it, all should be with the world. I'm going to collect this money because I'm selling an overvalued option.
Yeah,
Based
right.
on what we
Yeah.
talked
Don't
about,
spend it.
here's
Don't spend it. Don't write a check yet.
don't do it yet. Here's the way you should be looking at this. What is most likely to happen is that you're going to end up on this side of the curve and be disappointed that you wrote the call because it's trading much higher, or
Wait,
you're going to be on this side of
hold
the of the
hold
bell
on, time
curve
out.
and be
Time out. So, I mean, I did a buy rate and I bought the stock at 100 and I sold the 105 calls and the stock went to 110 and I'm disappointed. Is that what you're trying to say?
most people see it that way. You and I know better,
Ugh.
but but they're
All
going to
right.
say I gave up because or they'll say, how did this happen when I was selling something that was above fair value? They don't
Or how about
understand
this?
that was just a balancing point is all it was.
How about this? I sold the calls at 2, right? John, this is what John does, right? I sold the calls at 2 and now they're trading at 5. I'm a loser. Really? That's a crappy strategy. That's a terrible strategy. I'm never doing that.
Never touch
Really?
that one again.
Yeah,
Bad misperception.
meantime, the stock that you own the call against was 100 and now it's 110. So I'm going to just be a simpleton here and say, hey, I bought it 100 and it went to 110 and I made 10 and I sold them at 2 and they went to 5 and I lost 3. So therefore I made 10 and lost 3 and I made 7. Am I a loser? I don't really get what base that is where you're a loser.
Yeah.
I mean,
well, also, if you look at your risk graph, you've got unlimited downside. This is the risk. Going up is a missed opportunity.
It's missed opportunity.
But the other thing that's going to happen, the other side of the bell curve, is that this is also most likely to happen, either the red or the green, not the red dotted line. And in this case, you're going to be even more upset that you sold because now we've got this loss.
But I'm perplexed because when I sold them at 2, they were 3 points above fair value.
Or 10 points above fair value, right? So what we're trying to show you is that you have to have the right perspective. And that if you sell an option that is above fair value, it's a perception. Nobody says it's for sure above fair value. It's just a dividing line. And so if you sell this, expect it to either end up well above that number or well below that number, but not right on that number. And that's what dictates the strategy, not the fact that you're selling an overvalued option. And so we hope that at least gives people some food for thought. So once again, if you like ideas like this, things you're not going to get anywhere else because they're topics that professional traders know well, please visit marketrebellion.com/get started. So now, Stu, let's revisit our question.
One second before we get to that. Now, let's just go back a week or 2 or 3, whatever ago, and just think about the idea of fair, like what we're talking today, and fair value, and come up with the idea that if an option is trading at fair value at $2, should we really be expecting to make $2 on it if we sell it? Should we really be expecting to make money on it?
The long run is if you sell it for 2, it's going to cost you 2. If you pay 2, you're going to earn 2. But that's a long run average. You're just far more likely to be outside of that.
Value. If it's fair, if it's a fair value, how can I expect to make or lose any money? I mean,
right.
It's like opposing poles going on here.
Yeah. And it's a concept that most people overlook. So let's go back to our question here. Historic vol is at 20%, at the money call trading at 30%. I'm looking at my broker's platform and I go, hey, you know what? I'm going to sell this option because it's trading at 30% vol. It's overvalued and therefore I've got super high odds on my side. So what do you think about that, Stu? If somebody came to you for coaching and they said, I sold this option because it's trading above fair value, do you have an edge by selling that call?
I have no idea.
That's really the best answer. We have no idea. What we do know, in the long run, if you were able to sell this 10,000 times, yes, just like our coin flip that we open up the presentation with. But remember that fair value is just that horizontal line. You spend very little time there.
Yeah, it's just that piece of time. Yeah.
It's just a piece of time, and you spend far more time outside of it. So for those of you who are doing option strategies, especially when you're selling and saying my whole strategy is to sell options that are overvalued, you're probably looking at it the wrong way. It's not a good way to approach it. And so those are some of the things we just wanted to share with you to help you make better decisions. So Stu, any closing comments?
As usual, know your risk. Quantify your risk. Know what you're
Like
up
that one.
against.
I think that's going to be our mantra now from Steve.
Know your risk. Just don't assume anything. And in fact, how about this? Assume that you're going to get beat. It's kind of a good place to start. Assume you're going to get beat and quantify the number. And then use all your tools that are available to you, including strategy, charting, and whatever they are, fundamental analysis, whatever those tools are to help you gain the edge to achieve your goal.
Right.
But the point is, just know your risk, know what you're up against. Just like if you buy $100 stock, you may say, well, it might go to 50. All right, well, now you know your risk, because you know if you bought 100 shares and it went to 50, then you're going to lose 50 points on 100 shares. You know that. And I think where people go wrong, I know where people go wrong, is that they look at an option and they don't know what they're up against.
I have no idea.
They don't quantify that what's my loss going to be down 50 points or 20 points or 1 point or 2 points. They kind of wait for the market to tell them what that number is. And that is absolutely the wrong way to do it. You have to be the driver of the risk machine, not the market telling you how to drive.
Right.
You have to be the guy that knows those numbers.
And then they're shocked when it doesn't turn out the way they thought. Again, that's what we're trying to show. It's the main point. Their perception is wrong. They think, oh, I found something that's overvalued. That's all I need to know.
They blame it on the strategy, right? Isn't that what people do? Oh, this strategy blows. I'm not going to do that anymore. It's not the strategy.
They stop. It's a sample size of one. Yeah,
just that the outcome was, your outcome was incorrect. It could be a delta play, it could be a high volatility play, it could be both, it could be one or the other. It could be, you could have a neutral, delta neutral strategy playing implied volatility. And if the implied volatilities don't go your way, well, whose fault is that? Is it the strategy's fault?
Right.
I mean, it's an outcome. That's all. It's one of many, many outcomes that as risk managers, that's our job to consider. What are the possible outcomes?
Yeah. So the thing to take from this, I know we covered a lot of things, but really the main point is that whenever you see an implied volatility and you're thinking, oh, it's above fair value, hit the brakes a little bit. Remember what we talked about here. That is just a number that splits the crowd. The end result is far more likely to be well above that or well below it, but very unlikely to be right on it. And you need to account for what ifs and make that part of your strategy. So we hope that gives you some good things to think about. That's what we try to do here on Coach's Corner. We hope you enjoyed it and learned something. That's always what's most important. And so, Stu, thanks so much for all the tips and joining in here today. And we'll look for everybody next week, 4 p.m. Eastern Time, for the next Coach's Corner. We'll see you then. Thank you.
Take care.